All right, hello again, everybody. This is Mike Rixey with NetPicks, and in today's video, I want to talk about how important strategy selection is, especially in this market. We're going to talk about why it's important to have a toolbox of different strategies at your disposal. I see way too many retail traders right now throwing everything they've got at just buying outright calls and puts. And it can work, especially when the moves are as big as they have been here recently. But what happens when conditions change? What you don't want to do is fall into that trap of focusing on one strategy, then having markets change, and then everything you're doing breaks down. Then you're left with a lot of inconsistency, you're left with a lot of frustration, and we don't want to get to that point as traders. Now, am I opposed to buying calls and puts? Absolutely not. I do it myself. I think it's an important part of being an options trader. What I'm against is going to that route exclusively. You really want to have a mix of strategies at your disposal. So let's dive in and talk about what that looks like. Now, if we take a look at this move to the downside, it's been impressive. No doubt about it. We've had this much needed pullback over the past number of weeks. During that stretch, not only did we see stocks sell off, but we also saw volatility come to life. And we saw many options get expensive because of that volatility, right? If I jump over to the trade page, if we take a look at the prices of some of these options, they've actually come down over the past few days, but they have gotten very expensive. Now, why is that? What traders have to realize, and there's a lot of newer retail traders that just don't understand the pricing model of an option. They think all you have to do is pick direction right, and you're good to go. Well, if I bring up a quick slide here, you've got to realize that for an option to be priced, there's 6 different inputs that go into the model. All right, and you can see them on the left side of this cloud. You've got stock price, strike price, time to expiration, volatility, interest rates, and dividends. Now, thank goodness we don't have to sit there and make all these calculations ourselves. The broker platforms do that for us. But it is important to understand that it's not just stock price that's going to impact the price of your option. It's not just trying to form a bullish or a bearish opinion on the stock. That's part of it. But we also have to understand that there's a couple of big ones in here. The time to expiration, that's the theta, right? We know that as you hold an option, it's going to lose value every day strictly from the time decay adding up. It's a decaying asset. Again, as long as you get a big enough directional move in your favor, not a big deal. But if you're wrong on direction and you have to sit there and hold your position for any length of time, that time decay can hurt you in a big way. The other big one is volatility. All right, so when volatility gets elevated, like it has over the past number of weeks, the options get much pricier. The market makers are pricing in the uncertainty of the market into the option markets, and that's why you started to see things really get expensive. I talked to some of our traders that were pulling their hair out a little bit because what they were doing a few months ago got way more expensive over the past few weeks, just strictly due to that volatility increasing. Now, how do we know if volatility is high or low? A couple of tools that I like to use. You can just look at volatility of the market as a whole, and for that we can use the VIX. Over on the left-hand side in my watch list, you'll see VIX. Anything in the upper teens or above is considered pretty decent volatility. When you start to get into the 20s or even 30s in some cases, you know that things are getting expensive. Right? If I jump over to a daily chart and switch this from SPY to the VIX, you'll see that historically you're going to get spikes. Okay, we had one here mid-year last year. We've had some stretches here where you get a couple of days, maybe a week or two, where the VIX starts to spike. And we just got one here. No surprise, as equities were selling off, volatility pumped up and actually touched 30. Notice what's happened since then, though. Right? You get this fear to spike, everything gets expensive, and then when the world doesn't come to an end, you know that volatility is going to normalize. They're going to start to suck that volatility back out. And that's exactly what's happened over the past week or so, right? The world didn't come to an end, the market didn't crash, and now volatility has started to contract again. So what we know about volatility is when it starts to elevate, when it gets expensive, we know it typically will last a couple of days out to a couple of weeks. And then it'll start to contract. Why is that important? Because if I have a strategy in my toolbox that can take advantage of that volatility contraction, now I'm going to start to stack the deck in my favor. Now, if we go to, let's go from the volatility of the market as a whole to a specific stock or ETF, in this case, SPY. At the bottom of the Thinkorswim platform, and you can find this data in just about any broker platform that you're using. Let's scroll down and let's take a look at this section at the bottom where it says today's option statistics. and it's going to give us a feel for whether volatility on SPY is high or low. And the way it does it is it compares the current level of volatility to the last 52 weeks. If I take a look at the current implied volatility being used to price these options, it's just below 20%. Well, how do I know if that's higher or low? Well, if I take a look here at the top two on this list, it's the 52-week high for implied volatility and the 52-week low. The 52-week high is at 36%. The 52-week low is at 11%. So what it does is it takes the current level of implied volatility, it compares it to the 52-week range on that product, and it tells us how often have we been higher or lower than the current level. And for that, I like to look at the IV percentile. It's at 33. So it's just telling us, okay, how often have we seen volatility higher than the current levels or lower than the current levels? And with an IV percentile in the 30s, you know that there's actually some pretty decent volatility being pumped in. What I classify as a decent level of volatility, when you start to get into the 30s, right, especially the mid to upper 30s, you know that things are starting to get expensive. If you're just going to buy options, you're going to pay up for them. They're definitely going to be more expensive. Those of you that have traded SPY in the past, you know, over the past couple of weeks, everything was much more expensive, right? Almost twice as expensive as normal as they started to pump the fear into the market. So if you're going to buy a call or a put, it's going to tie up more capital and it's going to put more pressure on needing that big directional move in your favor. Well, what if you don't want to be that aggressive? What other strategies can you use? Well, I talked about it in yesterday's video. If you haven't had a chance to look at it, you can go back and review it. But we talked about why we like to use credit spread so much. If I came in, let's go back to that daily chart of SPY. If we came in and took a look at SPY and said, you know what, I'm bullish. I think the worst is over with. I think we're going to start to bounce. I want to put on a bullish trade. I'm just going to come in and buy an outright call. Well, if I go out, and let's just go out to the one-day options. Let's say it's a very short-term outlook. I typically like to go to the in-the-money options. I like to go a couple strikes in the money, get a high-quality position. Well, if I go a couple strikes in the money here, let's just say I go to the 568 calls. They're almost $300 per contract, which may not be a big deal. You may be able to stomach that. You've got the account size that, you know, we can keep that risk pretty small. But if I buy a call option, I have exactly one way of making money. I need the stock to move to the upside, and it's got to do so very, very quickly. If it's not a big enough move or if it takes too long, I'm in trouble. Well, what if I'm looking at that daily chart and saying, you know what, I'm bullish, but I don't want to be as aggressive. I want to be a little bit more conservative. What else could I do? So I want to talk about a strategy that we just used with our members yesterday afternoon. And there's so many benefits to this, and I'm going to cover them here next. So what we did yesterday afternoon, we did want a bullish trade coming into this morning. It didn't mean that I was calling a big major market bottom, that I'm expecting the market to rocket higher in the next few weeks. I was looking at what's going to happen over the next 24 hours. Could we potentially get the rally that started yesterday? Could we see it continue into the first part of today's session? It's what we call our overnight pop trade. So instead of coming in and buying an outright call, we came in and we sold a put credit spread. And specifically, trying to check my strikes just to make sure I get them right here. So specifically, we sold the 565, 563 put credit spread. So it is this guy right here. And we collected 55 cents to put this trade on here yesterday. Right, so we collected $55 per spread. It tied up $145 of our capital per spread. That was my max risk on the trade. So right there, instead of buying the call option for $300, I'm lowering the cost down to $150. I'm cutting my cost in half. So I'm able to put on a more conservative trade right there just from the cost perspective. But to take it a step further, if I buy the call, I've got one way of making money. If I sell the put credit spread, tying up less capital, and now I give myself 5 ways of making money on the trade. We made money on this one if the stock moved up, down, or sideways, as long as price stayed above the strike price of the option that we sold, in this case 565. We also made money from the time decay adding up and from volatility decreasing. Any combination of those 5 were going to help me. If we saw a big move higher, great. If we saw the market just sit and move straight sideways, I was okay there too. And then if I was dead wrong, if the market started to move against me, as long as it stayed above 565, I was good to go. Well, overnight, markets sold off. During the European session, we saw the S&P futures down 30, 40 points. So right there, I was dead wrong on direction. We were not seeing the bounce continue into the early part of this morning. So this trade was underwater. Okay, no doubt about it. We sent this alert out to our members yesterday afternoon. We sent it out around 3:52-ish or so p.m. Eastern time, just before the market closed. And first thing this morning, we're already underwater. So now what do I do? What do I do with a trade that goes against me? Well, first things first, I'm not going to panic, right? If we're using proper position size, it shouldn't lead me to being in a big drawdown or wiping out an account because of one losing trade. Also, with the credit spread, it can recover it much faster because not only does the directional movement help us, but the time decay helps us as well. And with only 24 hours left to expiration, the time decay is considerable. These options are going to lose value all day long strictly from that time decay adding up. That's going to help us. That's going to help us recover very quickly. Now, fortunately, we did get a bounce. SPY, last time I checked, it's almost $8 off of the low from this morning. So that directional move 100% helped us. But the time decay also helped us. We also have the VIX down 48 cents. That helped us. So now I've got multiple factors working in my favor. I went from being down money on this trade right at the open to we ended up closing it out for a partial profit. Now, was it a record-breaking profit? It wasn't, but we went from being underwater right at the open to within the first hour of the session, we had already closed it out for a profit. A lot of it was due to strategy selection, right? We used the right strategy. It gave us a forgiving trade. We were able to recover very quickly. So now, instead of just coming in and saying, well, do I need to be bullish or bearish? And whether I make money or not, it's going to depend on whether I'm right on my directional outlook. Now I'm taking a look at volatility. I'm using a strategy that's going to be more forgiving, tie up less capital, and give me multiple ways of making money. That is why I love this approach. Again, like I said earlier, I'm not opposed to buying calls and puts. I think that's it should be a part of everybody's trading. But you also want to have these other strategies in play. It's a huge part of what I do because, again, we opened this trade 3:52 p.m. Eastern time yesterday, just before the market closed. We closed it out this morning within the first hour of the session. So we're in and out. I'm not tying up my capital for weeks on end, not tying up the rest of my day, right? I'm able to move on to other things like recording this video. So now I'm able to free up my day, free up my capital, and I move on to the next trade. We like to take between 3 and 5 of these trades a week. SPY does have daily options, which is great. We have opportunities like this all the time. And we send these alerts out to our members in real time whenever we're opening and closing positions. Now, we are going to be holding a live training coming up next week where I'm going to get into this strategy in more detail. Right? How did I come up with my bullish outlook? How did I select the strikes? How did I structure this trade? And how did I manage the trade? How did I pick my target? How did I limit the damage and use a stop on the trade? We're going to walk through all of that in detail. So make sure you click on the link in the description of this video. We'd love to have you join us for the training next week. It's completely free, no charge to attend, and we're going to open up our playbook to you. We're going to show you exactly how we utilize the overnight pop trades in our own trading each and every week. So if you have any questions, feel free to post comments on the video and I'll get back to those as quickly as possible. Otherwise, I'm going to wrap this video up, guys. I'll be back with you guys tomorrow for our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.